If you're running multiple fix and flip projects at the same time, there's one tool that most investors don't even know exists. It can completely change how much cash you need every month. And I'm talking about interest reserves. And today I'm going to explain what they are, how they work, and whether you should use one on your next deal. I'm Aiden, and I've funded hundreds of millions of dollars in hard money loans for real estate investors across the country. Interest reserves come up in almost every conversation I have with borrowers nowadays because when you're juggling two, three, four projects at once, your monthly interest payments stack up fast. That's where deals fall apart, not because the deal was bad, but because an investor ran out of cash. Let me show you how we're going to avoid that. So here's what we're covering. First, what an interest reserve actually is and how it works. Second, a real example showing you how it changes your monthly cash needs. And third, when it makes sense to use one versus when you're better off without it. Let's get into it. What an interest reserve is. It's a portion of your loan set aside at closing to cover monthly interest payments. So instead of paying interest out of your bank account each month, it gets taken from this reserve account. The money is built into the loan. You're borrowing it, not paying for it up front. This reduces your monthly cash outflow during the project. This is not extremely common on fix and flip loans or construction loans, but it's worth the effort to try find a lender who does offer it, like we do. Once you start using interest reserves, it'll be hard to transition to a lender who doesn't offer it. We have clients running 10 projects at a time with over $100,000 a month in required interest payments that we cover through the built-in interest reserve. With another lender, they may be having to put that money up every single month and ensuring that they constantly have enough cash on hand to cover not only those payments, but the standard cost of holding. So, how does this interest reserve, or IR as it's often referred to, work mechanically? At closing, the lender sets aside X amounts of interest into the loan. Each month, your interest payment is deducted from that reserve automatically. You don't have to write a check, it comes out of the funds that the lender sets aside. When you sell or refinance, whatever's left in that reserve comes back to you. If that project takes longer than planned and the reserves run dry, that's only when you start having to pay out of pocket. So let's take a look at an example with interest reserves and without. A $400,000 loan, 10% interest, Dutch interest, we're looking at $3,333 a month in interest. Without a reserve, you're paying that $3,333 out of pocket every single month. With a 6-month interest reserve built in, there's 20K set aside at closing for that interest. For 6 months, you pay nothing out of pocket on interest. That 20,000 came from the loan itself, not your bank account. So the trade-off is your loan amount total is slightly higher with interest reserve than without. Why does this matter for scaling? One project at $3,333 a month of interest is pretty manageable. 3 projects at that amount equals 10K a month in interest alone. That cash strain limits how many deals you can run simultaneously. Interest reserves free up that monthly capital. It lets you keep cash liquid for rehab costs, unexpected expenses, or the next deal. The investors who scale fastest use these interest reserves strategically. So, of course, there's a trade off. What does it cost you? Your loan amount increases because the reserve is borrowed money. Therefore, your origination fee, which is a percent of the loan amount, also increases. If you finish that project fast, you may have paid excessive points for reserves that you didn't end up needing. And again, you're paying interest on that interest reserve, which is technically interest on interest. It's not free money, it's a cash flow management tool. Think of it like insurance for your monthly budget. When to use an interest reserve? 1, you're running multiple projects at once. 2, the rehab timeline is going to be 4, 5, 6 or more months. 3, your cash reserves are tight and you need that breathing room. 4, you want predictable monthly expenses during the hold period. Or 5, you're doing major renovation or ground up construction with that long timeline. And on the flip side, what are some situations where you might not need an interest reserve? 1, if you have strong cash reserves and monthly payments aren't a concern. 2, the project is quick, 2 to 3 months in and out. 3, you're only running one deal at a time, so you're not concerned with scaling. Or 4, you want to keep your total loan amount as low as possible. And if you're looking at a deal right now and trying to figure out how the monthly payments would actually look with or without an interest reserve, we built a free hard money approval calculator. You plug in the numbers for your deal and it shows you whether the math works for your hard money before you even have to talk to a lender. Click the link below to try it out. So interest reserves, again, aren't flashy and nobody talks about them on YouTube, but they're one of the most practical tools in your financing when you're scaling. Now you know what they are, how the math works, and when to actually use them. Subscribe because I've got a lot more coming on the details that actually matter when you're funding your real estate deals. Thank you.